The Bank of Montreal, that is BMO, is facing a challenging moment in the financial spotlight as its latest earnings report reveals a significant drop in its stock price. The Canadian banking giant's shares fell by as much as 6.4% during morning trading today, following a disappointing earnings report for the fiscal third quarter. The bank reported a net income of $1.86 billion, or $2.48 per share, for the 3 months ending July 31st, which is an improvement from last year's $1.56 billion, or $2.12 per share. However, adjusted earnings of $2.64 per share fell short of analysts' expectations of $2.75 per share, according to Bloomberg. A major factor contributing to this underperformance is BMO's increased provisions for loan losses. The bank set aside $906 million to cover potential bad loans, a significant jump from the $492 million allocated in the same quarter last year. This rise in provisions reflects the bank's concerns over clients struggling with prolonged high interest rates, which have put pressure on both personal and commercial borrowers. BMO's difficulties are partly attributed to its U.S. retail segment, which has been underperforming. The bank's American operations saw a 9% drop in net income compared to the previous year when measured in U.S. dollars. This decline highlights the challenges BMO faces after its $16.3 billion acquisition of Bank of the West last year, which added nearly 1.8 million customers and more than 500 branches to its portfolio. The integration of this sizable U.S. acquisition appears to be more complex than anticipated, contributing to the bank's increased loan loss provisions. In a conference call with analysts, BMO's CEO, Darryl White, acknowledged the bank's struggle with higher-than-expected loan losses. He explained that the increase in credit costs was driven by a combination of factors including high interest rates, economic uncertainty, and shifting consumer preferences. White also noted that the unpredictability of losses from certain large accounts has added to the bank's challenges. Despite these issues, there were some positive highlights in BMO's report. The bank's Canadian banking operations saw a 4% increase in earnings, driven by a 7% rise in revenue. Loan balances grew by 5%, and credit card balances surged by 18%. Additionally, BMO's quarterly dividend was maintained at $1.55 per share, an increase of 5% from the previous year. The overall outlook remains cautious, as BMO expects loan loss provisions to stay elevated in the near term. White indicated that the bank anticipates returning to its long-term average levels of provisions by 2025. However, the current situation reflects broader challenges facing Canadian banks, many of which are grappling with high interest rates and evolving market conditions. In contrast, Scotiabank, another major Canadian lender, reported a better-than-expected profit, buoyed by strong performance in both domestic and international markets. This divergence highlights the varying impacts of current economic pressures on different financial institutions. As BMO navigates these turbulent waters, investors and analysts will be closely watching how the bank adjusts its strategies and manages its credit risks in the coming quarters. Stay subscribed for more videos.